Thank you for watching the deal preview video for the Walcott Jeffersonville Apartments, the latest multifamily investment opportunity presented by Gray Capital. Now, this will be a longer video where I take you through the entire investment opportunity for the Walcott. You can access the full investment deck, due diligence materials, and more, the ability to schedule a meeting with a member of the Gray Capital Investor Relations team, all on the Gray Capital portal. So I highly encourage you, if you don't have an account on the Gray Capital portal, request access right away, get the materials, schedule a meeting. I mean, if you're already an investor with access in the portal, never hesitate to reach out and schedule a meeting where we can go through the details of the Walcott, because this is an incredibly exciting opportunity. It's one truly that the Gray Capital team and myself have been looking for years. We love the idea of buying newer, higher quality, A-class multifamily assets that have a high intrinsic value, but where we can buy them less than it would cost to actually build that community and below the price that similar projects have been selling for recently. But most importantly, we need to find an asset that produces strong cash flow out of the gate. We're cash flow investors, something that we need to see in all of our acquisitions, and to find a newer property, typically with more competition, although there wasn't as much competition in this case, which I will get to in just a little bit. It's hard to find, especially with interest rates. Fortunately, we're assuming a loan on this acquisition that essentially removes interest rate risk for the majority of the project itself. So not to mention that the incredible location of this community and the robust economic growth that's going on in the Jeffersonville as well as the Louisville MSA, it's really exciting. It checks all of our boxes, and I'm excited to get into the details and share them with you. All right, let's start taking a look at the Walcott. And again, this will be relatively somewhat informal because I'm going to be taking through, might be a little long. We'll have some shorter videos, but I do want you to just hear about the project directly from myself. The Walcott, as I mentioned, located in Jeffersonville, Indiana. While it is located in downtown Jeffersonville, it's truly more acts as a suburb of the Louisville MSA. If you're looking for a quieter, slower pace of life, you're moving over to Jeffersonville from Louisville. That being said, Jeffersonville has seen a ton of growth over the last decade or so, with the Big Four bridge finally being constructed that actually terminates right in the front yard, essentially, in a park in front of the Walcott Apartments. Walcott, it's just right around the corner from all of the retail, shopping, and entertainment that is in downtown Jeffersonville. Great connectivity. I mentioned the Big Four bridge, but 65, the on-ramp, is about a block and a half away. So whether you're working at the River Ridge Commerce Center in Jeffersonville or you need to get across the river over to Louisville, it's really easy, highly connective, and it's exactly what our target demos are looking for in any market, but especially in Jeffersonville. And I want to share some of the highlights and some pictures of just how beautiful a property this is, and then I'll get into all the details, the numbers, and the returns, which it all looks great. Again, just really beautiful resort style pool. We found that renters who are especially of a younger demographic, they've come out of student housing, they're looking for highly amenitized apartment communities. They want a really nice pool, a nice fitness center, nice common shared spaces, in addition to having a really nice apartment unit of their own. This pool is absolutely beautiful. It checks all those boxes, but there's other areas throughout the property that really give us, again, this lifestyle element. And as the younger generations say, that it truly passes the vibe check. And as silly as that sounds, that is how renters today, younger generation, it's one of the reasons and how they're choosing apartments. Obviously location is important and budget is very important, but we're also talking about the generation that will DoorDash a Starbucks over to their apartment. So there is some disposable incomes, especially when we're looking at A-class assets, where these are largely renters some by choice, some by necessity. Many of these individuals may have been renters by choice, meaning that they could have purchased a home, but they have chosen to live in an apartment community. That's very common today. But now with interest rates and home prices being as high as they still are, so many of those folks that are well off, good incomes, They would have been able to afford a home, but no longer is that the case. But they're still looking for a really nice place to live, and the Walcott checks those boxes. Again, just beautiful, common spaces. Even the mailroom looks incredible. Billiard, pool room, it's all there. And so this checks from like a physical, and again, from the vibe check standpoint, the Walcott has everything that you could want. And now I'm jumping ahead a little bit, but I have to show just the location where Walcott is relative to where all of the shopping and retail and entertainment is in Jeffersonville. Right here on Spring Street, which again is just about a block and a half away from Walcott. You have this Big Four bridge that crosses the Ohio River down into Jeffersonville. It terminates right here in Colson Memorial Park, which is where the Jefferson Farmers Market is held. It's where the largest Beatles festival in the world is held once a year. This is right in front of the Walcott. 4.5 million people a year use this bridge. They walk across it and they walk right in front of the Walcott. This is an incredible advantage for residents, for renters who want to live in a connected, walkable neighborhood, but it has more of a suburban feel. It doesn't have all the hustle and bustle of Louisville. This is just exactly what we've been looking for. Before I talk more about the property, about Jeffersonville, I want to tell you a little bit about Gray Capital. If you're a current investor with Gray Capital, you can skip this section or you can watch it just to learn a little bit more about what's new. But Gray Capital, I'm incredibly proud of my team and our track record since we've been founded back in 2015. Gray Capital was founded by myself and my wife and partner, Alex Gray. We started investing as co-GP investors and partnerships, and we quickly, though, realized we had a little bit different view and way we wanted to run our business and how we wanted to buy and manage multifamily properties. So we started building out our own team, acquiring assets starting in 2019, which is started right into the pandemic. But today we're a fully vertically integrated multifamily investment firm with over 66 employees. We do our own in-house property management. We have a team of, I believe, are some of the best multifamily property management professionals in the Midwest. And we're also a quick and nimble team that embraces technology, fully utilizing new artificial intelligence products, easy ways to communicate, and data focused and centered, which we integrate with our in-house research team and reports under the Gray Report. But a little bit more that we're proud about is, one, we've never had to issue an unplanned capital call ever. Other syndicators and sponsors are dealing with capital calls and foreclosures. Our assets are cash flowing, they're performing well, and we don't anticipate having to issue any unplanned capital calls because of our ability to quantify risk, mitigate risk, and try to see around some of the corners and to avoid some of the pitfalls that others in our industry have faced. Capital preservation is our number one priority. We've proven it out over our 16 active projects, 10 full cycle deals. We've never lost a penny of investor capital. Part of our capital preservation is our number one priority. Part of that is we're strong focus on cash flow. We're cash flow investors. Every deal needs to have some robust cash flow out of the gate. Cash flow hasn't been as strong in recent years with interest rates and lower cap rates, but it's still something that we are adamant about. We have to see some strong cash flow. We don't have a loan maturity at Gray Capital until 2027. We're not up against the clock, and that's been a major tenet of our investment strategy. We want to use time to our advantage, not to have time work against us. That means longer term holds, typically fixed rate financing. We also strive for operational excellence. We're never done. We'll never stop improving our systems, our processes. We're not just in this business to do another deal and to make another fee. We're in this to do a true quality job. We want our investors to have the highest level investment experience, and we want our residents to have the best living and apartment experience compared to any apartment that they'll live in. We consistently get feedback from our investors saying we are the one syndicator that communicates better than all of the rest. We are fanatical about our communication, our transparency, and our availability. You can get in touch with a Gray Capital Investor Relations team member just about any hour of the day, and you can get in touch with me very quickly as well. Last piece, we are heavy investors into our own projects. Our average co-investment into our deals is around 14%. It's been as high as 24%. Typically, it's no less than 10%, and we're most likely going to have about a 10% co-investment on this project, around $1.5 million, although that number likely will increase over time. Just looking at our track record, as I mentioned, we have 16 active projects that are ongoing, with 10 full cycle deals averaging a 29% IRR. Well, let's jump back into the deal, getting over a little bit of the basics, going into why we love it, details of the property, the business plan, the market, and then we'll get into assessing some of the risks. We'll look at a case study, some sensitivity analysis for the deal, and then talk about timeline and next steps. We're acquiring the Walcott for $39,250,000. That comes out to $182,000 per unit. A recent sale just across the river in Louisville traded for around $230,000, about $50,000 more per unit compared to where we're buying the Walcott. The Walcott was built in 2020, so it's a pretty new property. It's a 215 units large, comprised of about 50% one bedrooms, and then about 40% two bedrooms, and then about 10% studios. It's really a core plus risk profile, and really with a value add return profile, but we're calling it a core plus strategy. There's not a large value add component. Really simply, we're buying a great piece of real estate at an irreplaceable location at a deep discount, and we're going to operate it better. We're going to reduce expenses. We're going to increase revenue by increasing rents over time. We're going to cash flow it, and we're going to sell it to achieve about a 2x equity multiple over 5 years, averaging about 6% cash flow and an IRR of about 15.7% based on a 5.5% exit cap rate. And I think all of these assumptions, which we'll get into in a little bit, are all very reasonable and realistic. And in fact, I don't really think that we are factoring in the robust rent growth that we will see in kind of mid-2026 and 2027 when supply levels are reduced to really almost like a decade low, which we should really see some strong rent growth, especially if we have some inflation still in the system. So why do we love this deal? Incredible location. Location. Not just Jeffersonville as a market itself, not just Louisville as the MSA, but being right where this Big Four bridge terminates, right at this park, right next to all of the retail shopping. It's so walkable. It's right next to I-65 without all the noise, though. It's about a block and a half away. Really, I couldn't get more excited about this location. It's a great basis. I just mentioned $183,000 per unit, way off the sales comps that have recently taken place. One could say we've got built-in equity as soon as we buy this deal. Tons of growth in Jeffersonville, 12% population growth since 2000, 3.8% job growth in 2024, and income growth that is also very robust, I think around 12% since 2020 as well. We are assuming a fixed rate Freddie Mac loan, still with 69 months of term, about 21 months of interest only. Interest rate's about 5.48%. If we got a new loan today, not the treasuries are all over the place, but if we got a new loan today, it would be in the mid sixes. So we're getting a much lower interest rate than we could if we went out onto the market. But not only that, but we don't have the interest rate risk between going under contract and closing on the project itself. I've done multiple deals in the last couple of years of where we're putting new debt in place. We're still going for a fixed rate loan, but the 10-year treasury moved 100 basis points from when we went under contract to when we closed, representing a ton of risk, especially to the sponsor, because we have a lot of hard earnest money that's at stake. We're spending a lot of money to do the deal, and frankly, the deal changes. So we had to retrade and renegotiate purchase prices in the past because of how much treasuries move. That's not a risk in this deal at all. Where it comes into place is where interest rates are when we look to exit or refinance in 5 years and how that affects cap rates. But for the first several years of operation, interest rate risk really is not a factor outside of how it affects other costs, inflation, and the general macro economy. Local advantage. Indiana, we are market experts in the state of Indiana. We're one of the largest multifamily owners in the state of Indiana. And I think we've got the best property management team in the state of Indiana as well. We know the laws, we know the policies. It's very tax-friendly, business-friendly, landlord-friendly. If I could do all my deals in Indiana, I would. We do deals outside of Indiana, Michigan, Kentucky, Ohio. I've done a deal in Illinois, although not a big fans of doing deals in Illinois. I'd love Indiana. The manufacturing resurgence that's going on in the Midwest. We're seeing robust job growth in all the major markets, whether that's Indianapolis, Columbus, or Louisville, Jeffersonville. It's a great place to be. And investors from the coast and elsewhere frankly, they see it as flyover country. They're not interested. They don't even know where some of these markets are. They've never heard of Jeffersonville. Little do they know, though, is that there are some pockets, Jeffersonville included, that's growing to similar demographic levels as markets in the Sun Belt, but it's not an crowded investment space. Markets in the Sun Belt are experiencing incredible population growth, great demand, but every investor and their brother has decided that that's where they're going to park their funds. That's why their cap rates got so low, and that's where folks got so overlevered, and that's where all the capital calls and distress are taking place. They're also in a lot of the value add deals, and not as much in the core plus deals, which shows that you can take less risk but still get robust returns. It's all about your strategy, where you're buying it, and how you're buying it. Not to mention, and this is on most projects, but the fact that we're going to be having robust cash flow distributions that are essentially sheltered through depreciation, having no true regular income tax liability in the year that they're distributed until we've burned through all our depreciation. There is depreciation recapture at the end of the deal, but it's a very tax-efficient way to produce really tax-sheltered income throughout the hold period. And as I mentioned earlier, we're going to be investing at least $1.5 million of our own capital into this deal. In terms of the fees and the structure, the minimum investment for Walcott is $100,000. That's been our standard for quite some time. We're looking at holding the deal for around 5 years. That's primarily tied to the term of the loan that we are assuming. We are exploring the option of refinancing at that 5-year mark. If it's a great property, we think that it has more growth opportunity, we'd love to refinance it, return capital, and continue a hold. Or if we think it's the right time to sell it at 5 years, that is another great option as well. We're offering a 7% preferred return, a 70-30 LP-GP split, and that results in an average of 6% cash on cash, 15.7 internal rate of return at the LP level, and a 2x equity multiple over those 5 years. In terms of our fees, we have an acquisition fee of 1.75%, 1% guarantee fee, 3% property management fee, and 2% asset management fee. So how those returns translate based upon how much money you would invest. We've broken out your average monthly distribution because we do distribute monthly, but also your yearly average cash flow. Now, these are also obviously projections, although we're confident on the first year of having at least 5%, but if not close to that 5.5% cash on cash return. That means if you were investing $250,000, you would be earning about $1,100 per month, or about $13,750 over the year. If you were investing $1 million, you'd be earning around $4,500 per month, or around $55,000 per year. Again, these are projections. Certainly things may change, but we are fairly confident in these cash flow projections. In terms to what we are going to do, what's the business plan? Put it very, very simply, we are buying an incredibly high value asset, high quality asset at a great price in a great location, where we have the proven track record to operate more efficiently these types of assets, where we can reduce expenses, drive rents, and increase returns. We've done this before on several assets, whether it's Villas on Fur or Echo Park, but it's all through our in-house property management teams at Gray Residential. The way we use technology, a core component of that is our RealPage's suite of products, including RealPage's AI RM, their AI revenue management system, which essentially adjusts our lease expiration window, understanding what our availability is, where the market is, and to be able to maximize rent growth and reduce vacancy loss at the property itself, which has a proven track record of driving revenue and increasing returns. We really want to leverage the asset's location, leaning into where we are in Jeffersonville, doing a lot of boots on the ground, guerrilla marketing that we've done in other projects, again, to not really spend as much money on marketing, but deliver results. We also do, we do a lot of things in-house, including digital marketing, where a lot of this gets farmed off to third parties that charge fees, and you're getting about half the ad spend you'd be doing if you're doing it yourself. We do all that ourselves. We've got the skill set and the personnel to do it. We've done it effectively, and we can do it at a fraction of the price as other operators that farm all of that out. Now, some of our goals. First, we're going to preserve principal. We're not going to lose an investor dollar. Everything, there's a risk in everything. It's equity. There's always risk, but we have never lost an investor dollar. We don't plan on doing it on this deal. We want to deliver a reliable stream of tax-sheltered cash flow, target of over 5% annually. We want to deliver a project-level IRR of 18%. That translates to about a 15.7% LP-level IRR. Our first option, sell the asset at 5 years to deliver a 2x equity multiple. Or option 2 would be to refinance around that time period, return as much capital as possible, and extend ownership over the next several years as we cash flow the property. But all LPs and investors will stay members and investors in the deal. Let's take a look at, again, we've shown some pictures, we've seen a handful of these, but some of the amenities at the property itself, large courtyards, gas fire pits, outdoor kitchens with gas grills, we've got business centers, conference rooms, pet wash station, rooftop. We've got a rooftop lounge, heated swimming pool that they actually keep open throughout the year, even in the winter. They use it as a leasing tool. It looks really nice. Beautiful fitness center, grilling cabanas, and again, right next to the Big Four Station Park. Also have an awesome, I don't have a picture of it right here, but has a full covered parking garage, charging right now. It had been charging $50 per parking spot. Comps are charging $100. Current management has increased that to $70. We think we can get all the way to $100 over the next couple of years, but highly amenitized and great features for residents. The units are also modern. They're clean. They look great. Granite countertops, stainless steel appliances, glass top cooktop range, full height tile backsplash, 9-foot ceilings, walk-in closets, and in-unit washers and dryers. And as I mentioned, about 50% are one beds, 40% are two beds, and 10% are studios. Again, really nice and well laid out floor plans. I was off on one of these statistics earlier. I said 12% household income growth. It's actually 26% household income growth. Talking about the Jeffersonville market itself, job growth has been just under 4% year over year, with rent growth in the Louisville MSA at 3.7%. That's compared to a national rent growth level of between 1% and 2%. It was negative last year. In total population growth in Jeffersonville is about 12% between 2020 and 2024. Tons of new and existing businesses. It's UPS's largest logistics facility in the world. Being on the Ohio River, there's tons of transportation, trade, and logistics businesses that are located there. Tons of manufacturers. $1 billion solar panel facilities opening up in Jeffersonville. Meta just announced an $800 million data center. The list goes on, and we've compiled a list that I highly recommend on the investment deck. Check out some of these economic development articles. The job growth in Jeffersonville and Louisville is just absolutely going gangbusters right now. But some of the themes: pro-business, tax-friendly, that's always in Indiana. It's affordable. Indiana's an affordable state. That's why we're seeing people moving into Indiana, especially in cities like Jeffersonville, like Indianapolis, Fort Wayne. It's an affordable state. Jeffersonville is an affordable city. We're a diverse, stable economy. There's manufacturing, there's logistics, there's healthcare, there's services. I mentioned that it's a major logistics hub. Lots of hospitals, medical facilities. We've mentioned trade. It's also a cultural destination. Louisville, Kentucky, we have the entire Bourbon Trail, that's just right across the river. Whether that's bourbon or horses, it's a unique part of the country, and Jeffersonville shares in that history. And then I've mentioned the manufacturing renaissance that's taking place in the Midwest, and Jeffersonville is just the front lines of where that is happening. Looking at a little bit broader on the regional map, you can see where Walcott is, just right here down. We're getting right across the river, right next to downtown Louisville, but you've got a whole river separating yourself, so you don't have all of the craziness from Louisville always coming over there. The River Ridge Commerce Center, which is over here in the top right, that is where the bulk of all of this new manufacturing, logistics and industrial jobs are taking place. But also we have the ports of Indiana, FedEx facility, a lot more over here towards the east. Also a little bit further north, just to the west of I-65. We also have a ton of jobs and employment. All of this is extremely easy to get to from the Walcott, which is right here downtown Jeffersonville. In terms of some of the market fundamentals relative to the Walcott, Jeffersonville, and Louisville, occupancy at the Walcott has been stable recently. They had a relatively slower lease up as the property was delivered right when supply was just coming onto the market. A lot of new supply. They had to lower their rents. Then they were able to raise their rents significantly, and they've been able to have stable occupancy now over this last year. Jeffersonville has had strong rent growth. So has Louisville, and occupancy has been stable in those markets as well. But seeing where the Walcott kind of shapes up compared to other assets in the market, you have to remind ourselves Walcott is one of the newer properties in the market, but it doesn't have the highest rents. There's several properties that have significantly higher rents, room for us to move over time, and all of these assets are increasing their rents as there is robust demand in Jeffersonville. So this is looking at an average square foot versus the average unit in rent. See, Walcott is kind of right in the middle in terms of the unit size. That makes sense. Again, Walcott has no 3-bedroom units. It's all studios 1s and 2s, so we wouldn't expect Walcott to be one of the larger units in terms of average square footage. This is taking all of the units into account. But in terms of a rent level, you can see there are quite a few properties that are above the Walcott, which this current 812, located in Jeffersonville, about a mile away from Walcott, a little less, is one of the primary comps. It's a newer property. I think the aesthetics of Walcott are superior, but current at 812 is a newer property. This is just the average rent. As you see, kind of Walcott is right here with a lot of the newer properties in the market, but then a handful of properties, about 5 others, are more than Walcott, anywhere between $50 and about $150. Looking at comparable 1-bedroom, you can see, again, Walcott certainly higher than Bolton Tie or Waterside, coming in average around $1,350. But then you have Main and Clay, the Jeff on 10th, and current 812, all pushing above $1,400, and really $1,425 at current. The 2 bedrooms, we have an even more spread, with the Walcott averaging around $1,750 per month, where a current 812, for example, is well over $2,000 per month. Quite a good spread there. Jeff on 10th, Bolton Tie, Main, and Clay, all higher than the Walcott. And I would say, the Walcott is a higher quality asset than the vast majority of some of these other properties you see further to the left. We always look to quantify risk so we can mitigate it and try. And one way to do that is seeing where this project really lands on the risk and return spectrum. Graphed out, typical profile of core plus, value add, and opportunistic. Walcott truly has a core plus risk profile. Again, there are not very many moving pieces to our strategy. We're buying a stabilized asset. We're going to operate it better. It's in a great location with a lot of demand. We're going to grow rents over time and reduce expenses. By doing that, because of the basis that we're buying it, we're able to achieve value-add returns well above a 15% IRR, but we're still not taking that much more risk. The risk in a value-add comes from, well, you have a lot of volatility and speculation, just seeing of we are going to spend X amount of money, which is speculation. You hope to spend $10,000 per unit, but it could cost $12,000 or $15,000. Then hoping that you can achieve a rent premium of $150, $250, but you may only achieve a $100 premium. There's a lot of risk in moving parts. Now, I love a good value add deal. We've done a ton of successful value add projects at Gray Capital. But what I like about Walcott is that just that risk is not present. We don't have to worry about that. We don't have to worry about a lot of construction projects. We can focus on the important things of providing a great living experience to residents, manage the property better, reduce expenses, and produce outside returns. But what are the risks of the Walcott? Because there's risks in everything. The team, we've identified 4 key risks to the deal. First off is new supply. There's still new supply coming on into Jeffersonville and to Louisville, as we'll bring back on this chart. Not nearly as there has been in the last several years. You see in 2025, it's reduced significantly. Now this is all of Louisville. But there's still in looks like Q3 we've got about 800 units coming online. In 2026, it's a fraction of even 2025, but there are still units coming online, and some of the recently delivered units still have to be absorbed. So we believe that, and we've underwritten that growth will be slower through 2025 and halfway through 2026 before things start to pick up. But the new supply is absolutely a risk. Runaway treasuries. Now, interest rate risk may not be clear and present in the first couple of years of ownership, but it does affect valuations and cap rates. There's a typical cap rate interest rate spread relative to the 10-year Treasury. And if the 10-year Treasury remains elevated for a long period of time, we could see further cap rate expansion, and it could put downward pressure on an exit valuation. Predicting where treasuries will be in 10 years is a challenge. I think we'll see higher rates than we did over the last cycle, but I don't think we're going to see runaway inflation also. We're a developed country with demographics that would lead to kind of steady growth. Now, that being said, I think the United States is a robust entrepreneurial country that can see a lot of growth. And so it might be a little bit volatile, but it is something we need to keep our eyes on. But it's not an immediate risk, but something to watch. The assumable loan, this is more of a risk to opportunity. There's a pretty steep prepayment penalty, especially for the first several years of ownership. And so we could potentially miss out on an opportunity to sell the property or refinance to completely different debt in 3 years or so because of our fixed rate loan. Now, in 5 years, that defeasance will have mostly burned off, and could be an opportunity to refinance or sell at that point. Additionally, we might find a buyer who is willing to cover our prepayment penalty because they want the deal so much, just because the valuation has increased. So it's more of a risk to opportunity for the first 3 years, but I'd rather remove that interest rate risk for the entirety of the deal than to have an opportunity in 3 years. It's a classic risk and return trade-off. We're going to trade off some potential return earlier on to really reduce risk for the overall hold of the project itself. The last risk, and I think the most important, because this is where people do lose their money, is gross mismanagement. The sponsor risk is, I think, everything. It's not really what property you're going to buy or where you're buying it. It's who you're investing with. And if you are going to invest in the Walcott, you need to have full confidence in Gray Capital and our team's ability to execute. We've got a long track record of doing that. Again, on very similar strategies and projects in the state of Indiana. But it's something you have to be absolutely confident with. But it's an absolute risk that any investment, and really in anything, is very always clear and present. On the topic of risks, I always like to stress test our model. We stress test it a ton of ways. One of the most basic ways though, is once we kind of have our base case underwriting in place, is to look at a sensitivity matrix of exit cap rates and hold periods, kind of looking at the entire range of outcomes. Brand new A-class deals are trading kind of in a 4.5 to call it 5.5 cap rate range right now. But I want to look at it if it goes all the way out to 6.5, which is where hardly even old vintage value add deals are trading. Even with treasuries are high, they're still barely trading for those cap rates. You could say that maybe they should, but they're not. We've selected a 5.5% cap rate. I think that's conservative and reasonable. I believe that we'll sell this asset for a 5 cap or below, but again, can't predict the future. So again, looking at that full spectrum. So let's say in year 3, which we're probably not going to sell, there's a prepayment penalty. But if we were, we'd be looking at a 6.5 cap of about 10%. If we sold within 3 years, we'd be at a 7.5% IRR. But at a 4.5 cap rate, we'd be at about a 30% IRR. I don't know. We're not selling in 3 years. I don't think we're getting a 4.5 cap rate. All it's possible, but I also don't think that the 6.5 is going to happen either. But realistically, at 60 months, at that 5-year mark, if we sell it at a 6.5 cap rate, that IRR will be at about a 10.5 or 1.6 multiple. If we sell for a 4.5, we're at about a 22% IRR or a 2.5 multiple. But again, we're assuming a 5.5, which gives us our 1571 IRR in a 2x multiple over that 5 years. Now, if we decided to refinance, hold on for several other years, we could be looking, for example, at a 5 cap at 10 years is an IRR of 14.5 for a 3.3x multiple. At a 6.5 exit cap, it's at 11.4. And that's just assuming we just kind of have the same debt terms throughout that period. Although if we would have a longer hold period, we would refinance at month 60. Hopefully we'd have a nice cash out at that period. In some cases, we might even deliver 100% of capital and continue the deal. In terms of break-even occupancy, again, just stress testing for physical occupancy. The first year, this is basically the physical occupancy level it would require for us to be unable to pay the mortgage payment out of cash flow from operations. We overcapitalize the deals that even if that happens, we still have the money to do it. But in the first year, break-even occupancy is at 77, followed by 75 in year 2. Our interest-only period burns off in year 3. We start amortizing our loan, but our break-even occupancy increases to 78%. And then in year 4, 74% break-even occupancy and 72% in year 5. So I think that looking at this range is helpful to see, if things got really bad, what are the levels of where we start seeing returns that are unacceptable, and also to see that if the market went the wrong way, if cap rates really expanded and we got in that environment of runaway treasuries, even if cap rates for brand new assets were at 6.5%. We're still getting returns akin to the long-term average of the S&P 500. So you may be asking yourself, well, this looks like a great deal. Why would somebody be selling this great asset? It's a pretty simple answer, and the fact is, this project is out on an island compared to the rest of the seller's portfolio. If you see on the left side of the screen, that is where all of the sellers of the property, their projects are, and a lot of these are sold. You can see Jeffersonville here is really out on an island. They have all of these sold projects. Their headquarters is in Florida, and they're trying to reallocate funds into opportunity zone projects in the Sun Belt. So this is from their corporate strategy point of view. They just don't want to operate a property up in the Midwest. They don't have anything else in the Midwest, and they're also a developer. They're not necessarily a buy and hold operator. So let's look at a case study of a project that is a very similar business plan as Walcott, and that is the Villas on Fur, located in Granger, Indiana, suburb of South Bend. Acquired this asset in 2020. Similar volatile economic period of uncertainty, not sure where things are going. We got a decent price on the property. I believe our business plan was to reduce expenses and to grow rents over time. And that's exactly what we did. property's been a great performer. It's been producing cash on cash well above 10% for the last several years. We'll be distributing on average 15% cash on cash of villas on FIR this year, and you can see below, just our quarterly net operating income growth has been really, truly robust. We started NOI at less than $1 million, and we are well over $1 million today. So it's been just a really a great property to operate. Similar strategy as Walcott. In terms of the timeline, we should be under contract around January 10th. It could be a little bit later. Our commitment window will open as soon as we are under contract, sometime in mid-January. We'll issue our capital call sometime near the end of February, and then close hopefully sometime mid-March. And then our first distribution will take place the month after we close, and we will begin those monthly distributions. If you have any questions whatsoever, you want to make sure that you do have an account on the Great Capital investment portal. You can go to greatcapitalllc.com to do that. There you'll find a deal room for the Walcott that has all the due diligence materials that we think that you'll want to see. We upload to that deal room, as well as underwriting deck, as well as contact information and a link to schedule a meeting with the Great Capital investment team and myself. Again, we're a transparent group. If you ever have any questions, never hesitate to reach out. If you're ever looking for a piece of information, never hesitate to get in touch with us. Any member of, whether it's the leadership team or any member of the Great Capital team, would be happy to sit down with you and answer your questions. All right. Well, I want to thank you for taking the time to watch this deal preview for the Walcott. Again, I highly encourage you to hop on over to the Great Capital portal if you've not done so. If you don't have an account, hop in, schedule a meeting with us. This is the smallest equity raise that Great Capital has done over our last two deals. River Club in Evansville was a $17.5 million equity raise. Solana was a $27.5 million equity raise. The Walcott is about a $15 million equity raise, and we already have more than a third of that committed. So at launch, we expect this to go relatively quickly, not trying to put any pressure on anyone. Want everyone to be able to take the time to do their due diligence, ask the questions. But this is one where we believe that it will be subscribed relatively quickly. All right, again, thank you for taking the time, digging into the Walcott. It's an exciting deal. I'm excited about it. Again, to buy something at this good of a location, this new, this nice, for $180,000 per unit, you can't build apartments for that cheap. And to know that apartments just sold across the river for almost $50,000 more per unit gives us an incredible amount of confidence that we're getting a great deal at a great price, and we're going to be cash flowing out of the gate because it's a stabilized core plus property. All right. Thanks again. Have a great rest of your day. Thanks for watching the video.